Well, Assalamu alaikum. So I hope everybody is getting the voice. Or so let me. Assalamu alaikum. Okay, so today we are here to discuss regarding your upcoming tax filing. So we'll discuss initially what's new for 2025 tax filing, and then we'll go over a little bit on the tax deductions, tax credits, and different tax referral like RRSP, home buyer, and basically we'll major our topic is FHSA account, which is new, and I found that so many people has some confusion about the FHSA account and how it works, who is eligible to contribute, and how you can withdraw the funds against your first home. Okay, so basically I will start like maybe some of you guys are new in Canada and want to know like who pays tax in Canada and who is liable to file the taxes in Canada. So basically everyone who is a resident of Canada, they have to file their taxes. So if you moved into, or maybe we can start that if you got an immigration to Canada, and you come to just visit to see how Canada is, and then you came, you never broke any ties with your previous country, move into Canada, and after a few months or maybe a week or two, you just left the country, and then you came back in future date, and then you start your residency at that day. So your first visit is not considered as your residency start because it's basically is just you never broke the ties and never started your residential ties with the Canada. So basically you will start your residence, start filing from the date you become a resident was the later date when you cut the ties and start living in Canada. So that's the time you start liable filing taxes in Canada. And basically, when as a resident you file the taxes, you declare your worldwide income. So if you came in Canada, you have some rental income in the country you live and your back home or whatever. So still that need to be included in your Canadian tax return. So basically that's how everybody file their taxes and they include their worldwide income. So if you're an employee in Canada, you file, you got your tax slips, your T4. If you have investment income like interest or dividend or some other rental income stuff, you declare in your personal tax. All these incomes goes to your personal tax, which is your employment, your self-employment, your investment income, rental, any other income, those all goes to your personal taxes. So basically people want to try out, okay, if as a employee we have any tax deduction, like we can lower down our taxes. So unfortunately when you are employee, you cannot deduct the expense. Even though if your job is in Markham, you drive every day over there, still you cannot claim your car expense and all those. But if, for example, if every day you go to your Markham office, and then your employer sent you in different places. For example, you are an engineer and they sent you on different sites, and they are not reimbursing you the mileage and stuff you are doing in different sites. Then they give you a T-2200 form, employment declaration form, to claim some of your expense which you incurred for your car maintenance and everything. But for that, you should have that form that you travel and or you work from home more than 50% of your employment duties, and then you have to keep a record of your mileage, where you went, which site you went, how many kilometers you drove, and then you prorate your car expense. For example, if you have a car insurance, car maintenance, car repair and everything, 100%, and then you drove 100,000 kilometers in any given year, and then from your mileage you track for your employment duties. If you find out it was 2,500 or some ever, so you prorate your expense and that you can claim. But when you are employee and you deduct employment expense, meaning work from home or any mileage expense, you have to keep in mind that you have to keep record of every of your slip. First of all, your employer give you T-2200 form. You have to keep it, and your mileage if you are claiming your car expense, okay, where you went every day and all those, because even though you have all the proof of your car gas paid, car insurance paid, but if you don't have a logbook maintaining your car mileage, they will not allow you to deduct any of the expense. And if you work from home, your employer is giving you T2200 form that because of the work duties, employer is asking you to work from home, more than 50% perform duties from home, still you have to prorate how's your total area of the house and what's the house related expense, meaning your rent or utilities or stuff. Okay, so that's how you can claim expense. Otherwise, usually employees cannot deduct most of the expense. Okay, so those are the major things. So many people are very consider RRSP, contributing in a RRSP when they are lowering down or tax deferring for future year. So keep it in mind that when you contribute anything in RRSP, so is just the tax deferral. So it's not instant tax saving. You see that, oh, you are getting a refund because you are contributing in RRSP, but in future or given later, any time, if you will withdraw any amount from RRSP, so you have to include in the income in the year. Okay, and some of the things we have to keep in mind when you consider, because I think March 2nd will be the last day to contribute in a RRSP if anybody is considering to contribute in a RRSP. So keep it in mind that it's always depend how much the tax deferred can be optional in your case, can be an option to your case. It's depend how you are in the higher tax bracket. So for example, if my income is 0, and if I want to contribute an RRSP 5,000, there will be no tax saving for me or no tax deferral because I don't have any tax liability. So, but a person who has a 50,000 income, if he want to contribute 5,000 in a RRSP, so he might be saving only 10 to 15%. So for example, if I contributed in RRSP 5,000, so I might be, my tax saving or for like a time being or tax deferral will be 10 to 15% of that 5,000. But a person who has a 100 plus income, 200 income, or 200,000 income, or 80,000 income, and a higher bracket, they might save 22 to 25% taxes. The people who has a higher than 150 income, they might save 35%. So RRSP is deduction. So your income and whatever the tax bracket you are, and whenever you will contribute an RRSP, that tax rate who apply to your taxable income, that much you basically save with the tax when you contribute an RRSP. So that's why if we get a clients and they comes in and say, oh, we contributed, we ask them to always contact your accountant first, and like in the February is the best time, because you get your last pay stub, you have an idea of what income bracket you are, you have maybe your T4, and because the RRSP deadline to deduct in the previous year is first 60 days of the new year as well. So that's why you have enough time to first go to book an appointment, go to your tax preparer, tell them what your income is, how much you have saved funds to contribute in a RRSP, and what could be your tax saving. It's not you just, because banks are usually very like looking forward for your RRSP contribution. Every tax sales person sitting in the bank, they want you to buy the RRSP as much as possible. Sometimes even they don't ask how, if you have a room to invest. So first of all, you must have a room. And so many people, they work in a good position in the like as employee, they already have their retirement pension plan as well, so where they and their employer are contributing in their RRSP. So might be every year when you have RRSP room available, might be every year whatever you and your employer is contributing in your RRSP plan is already consuming that room. So must check your room if you have a RRSP room first. And then the second thing is that how much is more beneficial for you. It's not always that the max up RRSP and you get the maximum benefit. It's always depend what tax bracket you are. So first tax bracket ends in around 57,000 of income. So you know if your income is under 57,000, so that means if you want to put anything in RRSP, you might be saving 10-15%. But if your income is 100,000, if you want to add anything in the RRSP, so you might be saving 22 to 25%. So it's depend. So 2% with different tax bracket save with the same amount of RRSP contribution differently. So that's what RRSP. And we always ask for the RRSP, like whenever you are close to your retirement age, start like thinking about the withdrawal, because then stop contributing and thinking about to withdrawal, because at the age of 71, you can no more be eligible for RRSP contribution. And whatever will be your already funds in RRSP, if at the date you are 71, it will be deemed disposed of altogether. So every year you try to defer your tax for future years, because everybody is telling you that when you will be retired, your income will be low, you will be in the low tax bracket, and at that time when you will take this money out, you will pay less taxes. But all of the sudden, you become 71, you had 500,000 sitting in the RRSP plan or 300,000. Now, if all jump into that year in your income, so you will be automatically in a higher bracket. So you will be end up paying higher taxes. Okay, so you have to start planning after 60s that you want to withdraw, or you have to stop putting in if you don't like RIF. So they tell you that, okay, at the age of 71, either take all money out, even you don't take out, it will be deemed disposed and will be taxed in the same year in your hand, or you just convert into RIF. So RIF is the plan where they will just make an annuity payment that it will be installment paid to you. So you will no longer will be had an option to take all your money out, but now it will be every year, month by monthly basis, you will take out the money. Okay, and then you will pay low bracket if you want. But so many of us, they work good jobs, they have their work pension, they have their rental income, and they have their old age benefit and the CPP and everything, and plus all these RIF payment, still they make you pay higher taxes. So you have to plan carefully, and all of the sudden if somebody died, so, and at the end of the day, you have to pay tax on the same end. Spousal, like RRSP, if your wife is beneficiary, most of the cases, it's roll over to your wife hand, and until she passed away, still tax deferred in that plan. But if when she passed away, all your beneficiary, maybe kids or whatever, it will be disposed to them before, but you have to decease final return, pay all the taxes at once. Okay, so you don't have a control on anybody had control on the death. Okay, but at the age of 71, before you can plan. But some people like the RIF. They say, okay, our kids will not take care of us, we will be old, so even these installment payments will help you to survive. So that could be a case, is not. But the thing I always present to my clients, that don't go for like just maxing up with the RRSP and stuff, because for example, many of graduating this year from university and start their work. So maybe they hired by the employer at 60,000 income, 40,000 income. So if they start putting in RRSP, okay, but few years after they reach at 200,000 income, 120,000, and now if they want that in RRSP withdrawal, anything for buying home or anything, so they end up paying more taxes what initially they contributed and save the taxes. So initially it's not good to contribute too much in a RRSP until you reach certain high income bracket. And again, another option is, like everybody who contribute a RRSP, they have to consider time value of money. So 10 years before, what was the dollar value is not the same today. So I remember when we came, like $10,000-15,000 was the down payment of the house, okay, and it was considered a big amount. But now it's 200,000 maybe a value, or like could be a down payment. So you give your money to bank and people to invest and get a higher return, and you are just looking at just what the tax you are deferring. And even I don't tell that is a tax saving, because it's just tax deferral for the future year. So be like wise with your decision with the RRSP. I ask for the new generation people, like, yes, if you never bought your first home, then consider RRSP, because at least you can withdraw against your first time home buyer, and then it's not eventually taxed on the same year. It distributed in 15 years to be your income, and also 2 years is not included. So if you withdraw from RRSP any amount, you have to pay tax in that year. But if you withdraw against the first time home buyer, 2 years is not included in your income, and after 2 years it divided by 15 and it's included in your income. So you have a choice whether you pay tax on that inclusion of the income, or you just put it back that amount to not pay tax. So for example, if you withdraw 15,000 from your RRSP, and now if you withdraw in 2026, so it will not included in your 2026 income, 2027 income, and 1,000 included in your 2028 income. So at your option to pay tax on is extra 1,000 including as an income, or pay back 1,000 in RRSP to offset that inclusion. So, but home buyer could be a good, because you are a little bit keeping aside some down payment of the house, plus you are getting some of the refund like as a tax deferral. But home buyer could be a good option. But after first time you use your home buyer, just like then think twice to contributing anything RRSP. So that's a basic thing. First time home buyer, again, when you buy the home, you have to also consider that it's like you have to maintain a time period before the closing of the house to contribute in a RRSP, and then withdrawal and everything. So like better than RRSP, they now introduced it first home saving account. Looking at the market, people cannot afford the house buying and stuff. They introduced from the last 2 year FHSA account. And I see so many even like very educated people make mistake. I had got a client, he came to me and he said, oh, I contributed in FHSA account. I open up my FHSA account. And I said, oh, but you already have your home. He said, but that home is my name. I open up with my wife's name. So that's the common mistake we make. And because the husband and wife and under 18, the kids, they consider the principal resident home is one home, okay? So it's not, you can have a separate home and your wife can have a separate. So neither you can claim a, if you sell your principal residence, and so you get a principal resident exemption, and where you don't pay tax on capital gain of the home you live in, but it's only one family home. You cannot say my under kids, 18 kids, 4 kids have 4 different homes, and one home is for me, and one home for my wife, and only one home you guys all living in, and rest all the houses are on rent. Okay, so that's another people. So FHSA account, because if you open up a RRSP account, RRSP can be a normal RRSP, saving for your future, or you can withdraw funds against your first time home buyer. But FHSA account is very like a specific for the first home buyer account. So if last 4 years you had no home, home means where you live, not house. So you never had a home, even jointly with your parents or spouse or anybody. Okay, so then you can open up the FHSA account. You can contribute on the lifetime 40,000. Initially we have 40,000. I'm not sure whether they will increase this. So for example, if you open your FHSA account in 2026 today, okay? So if you contribute, you can maximum per year contribute 8,000. And within 15 years after opening the FHSA account, you have 15 years you can keep your account open. And in 15 years, you can either pay in first 4 years 8,000 and make it like first 5 year make 8,000 every year and like reach at 40,000, and then you cannot contribute anything else. Or every year you start putting in 2,000, 4,000, 3,000, and maximum up to 40,000 for these 15 years. Okay, this can only be withdrawn against your first time home. So if you become a non-resident before buying a home, so that will be consequences. You have to seek the advice because you cannot just withdraw the fund like RRSP. Okay, so anybody who is like I was taking a client, he wrongly opened up, but it was very initial stage. So we requested and we talked to CRA and we was able to cancel his account, but now they don't let you cancel. Okay, so you have to convert into RRSP, transfer this fund to RRSP, and you cannot withdraw it, okay, or transfer to your RIF, but you cannot withdraw. So that's why it's very important you know the, yes. Yes, yes, no, for your, it will be FHS account for your kids, and they can open up their FHS account. But again, you can open up, for example, if your son graduated this year, he got the job for 40,000 or 50,000. He know that 8,000 contribution will not save him a lot. Maybe he has a tuition credit or somewhere. So might be you still will open up the account. So because it's your room is carried forward. So for example, this year he opened, but next 5 years he don't contribute anything in FHSA. So his room is already 40,000. Maybe after 5th year, on the 6th year, he got like a very high, good job, and he know that if he contribute at once 40,000, he will save a lot of. And plus, if he suddenly had a decision he made that he will buy the home, okay? So he can right away buy the home, the same like after 5 years, put all together 40,000. Okay, so it means if he open up account, it's not mandatory that he is putting something, but it's a good to have a long-term open up account so your room is accumulated. Okay, and good thing about FHSA that even like for RRSP, there will be 90 days that money should be in your RRSP account before withdrawing against the first-time home buyer. But FHSA, there is no requirement that amount should be before. Even if you bought the home, within 30 days, you can put the money in FHSA and draw it. But for that, it's like important that you should open up the account. So only thing is that once you open the account, you have 15 years to keep the account open. Or if you become 71 earlier than that, then means it's done. You have to like close the account. But if you are young, you just open up the account, you have 15 years, if you can buy the home and contribute even at that day. Okay, so it's not mandatory you contribute today. So they can avail. One thing another that so many of us parents, we have some properties for our kids. Okay, so we are keeping, like for example, you have a 2 investment home where your intention is to give it to your kids. You have 3 kids. So you are thinking that, okay, the principal home I have, I will give to my 1 kid, and 2 investment properties will be my other kids. So I saw even those type of kids, they comes to me and they open up the FHSA account. But now, see, there will be no home buying for that kids because they will get from their parents. You can sell your investment properties to your kids, okay? But then there will be a land transfer. But if you will transfer as a gift to your kids, so you will save the land transfer, but there will be no home buying for them, okay? So be careful. Some of us, we already have, or some of us included maybe. For so many people are from us, for the time of the mortgage when they go, they put their kid's name, 1% or 2%. So they are jointly, and they live in that house. Okay, so in this case, they are jointly owner of the house if they live and maintaining the same house as in a home. So be careful, they cannot open the FHSA account because they are jointly owner and they are living. But for example, if you want to buy an investment property and now you just bought it on your son name, and so many of us, they do, because there is some rebate for first home buyer from the lawyer they do, in the land transfer and the first home credit. They tell their lawyer that claim those for us. Okay, so even though you claim that first time home buyer rebate and something, but still if it's an investment property, it's not considered home. Okay, so if they live in that house as a principal resident, yes, that will be their home, and they cannot be a separate home for FHSA. But if it was from you just for those rebate you told and you claim those rebate, but in reality is not the home. Okay, so you can still, maybe the land transfer unit can come back to you and say, oh, you got that rebate, but your kids were not living in there. It was not home. But at least Canada Revenue Agency cannot say, oh, you had a home before, because it was purely investment property and they never. So for FHSA, I'd got a client where he withdraw against the home buyer and also from the FHSA, but due to her mom's situation and something, he couldn't move in. Okay, for FHSA account, you must move into that property within 1 year. And for home buyer, you must move into that property. Otherwise, you have to, special forms to have to file, explain the Canada Revenue Agency that your basic intention was to move in. For some reason, you couldn't. So they allow you to withdraw that. But then you put it back, that amount you withdraw against the home buyer, and then you can just offset that. So that's a very like a mandatory thing. So that's the basically. So above 18 is a mandatory for FHSA account. You must be a Canadian resident, and last 4 years you never had any home jointly with spouse, parents, or anyone. So that's the condition.
Is it 40,000 like for husband and wife, each one, or it's combined 40,000?
40,000 for husband and wife, 40,000 each. No, each, yeah, they can draw 80,000 again. Yeah, so 40,000 you, 40,000 your spouse, they both can, but only against the one home, not for two separate. It's the home. Yeah, that's like, yeah, but it's 40,000. Maybe it increase after, but right now it's 40,000. They are increasing the from RRSP, like it was 25, 35, 40, so they are increasing, like how the inflation is impacting, and the now small amount is not like enough for the down payment.
So what's the difference between this one and the first home buyer plan from RRSP?
So RRSP is registered retired saving plan. Okay, it's basically you are saving for your old age. Okay, so today you are in a higher bracket, paying a lot of taxes. If you invest in the RRSP, that will be not included in your taxable income until you withdraw back from the RRSP. Okay, and for example, many of us, they just want the tax deferral, so they just put it in the RRSP, but mutual funds and stuff. But so many of us, they are really actively involved in the day trading and stuff. They put RRSP, but they use that RRSP to invest in different stocks and might be returned. So even that return is tax shelter until it's in that plan. So RRSP, they give you this option that if you never bought the house in last 5 years, some of your money from the RRSP you can withdraw and use it as a down payment towards house. So if you already have the house and you have a RRSP, whenever you will pull something from your RRSP, same year you have to pay tax. So if you put it 10,000 in 2025 in your RRSP, you never pay tax in that 10,000. In 2026 you pull, you will pay tax in 2026. Okay, but when you pull 40,000 against your first time home buyer from the RRSP, 2 years is not include your income, and even after 2 years is divided by 15, and only 1/15th part of that RRSP will be included. That's the big difference. FHSA is not for retirement saving plan. Is purely is for the first home saving plan. Okay, and the thing is that if you cannot first of all, you cannot buy the home, first time home buyer, open up the first time FHSA account if you already have a home. RRSP you can, okay, and FHSA is you put it the amount you is tax deferred. You pull the amount against the first home buyer is not included in the income. So RRSP eventually include in your income to pay tax, even if you withdraw against the first home buyer, but FHSA will not jump into your income forever. Yes. Yeah, for example, if your income is 100,000 and you put 8,000 in FHSA in this year, so 8,000 will not be taxable for you forever. Yeah, like RRSP. But RRSP, you pull, you pay tax. Even if you pull against the home buyer, eventually you pay tax. But FHSA, no, you will not pay tax.
And it will not be considered as an income also once you withdraw it.
Yes.
It will not be considered.
Yes. Yes, and RRSP, you had a RRSP amount sitting and you withdraw against the first time home buyer. For FHSA, you bought already the house. Even after buying, within 30 days, you can contribute anything in FHSA and pull. So, and its room is also accumulated, so 40,000. So it's, yeah. No.
Because when I bought the house, I had like 20,000 in my FSH account, and then they say you have to pay back those 20,000 in the next 15 years. So I have to keep paying them back.
No, that's RRSP, not FHSA.
FHSA is in use.
FHSA is exists from last 2 years. It's RRSP. Yeah, so RRSP, people think like when they withdraw, for example, you withdraw 15,000 in 2026. So if it's a normal RRSP, not for a home buyer, right away you have to pay tax on this 15,000. Okay, so if your income is 80,000, this 15,000 will maybe causing you around 28% taxes. Okay, but if you withdraw against the home buyer, it will not include it in this year. It will not include in next year, and even in 2028, it will be only included. The 1,000 will be included in your income. It divided by 15. So see, and now you have option. If you don't want to pay tax on 1,000, you just put it back 1,000 in RRSP. So you will get offset. It's included in your income, crossed by the RRSP. But if you say, oh, I don't mind paying tax on 1,000, at least it's not making you in a higher bracket. So it will be still beneficial.
Somebody told me that you have to pay back this, so they pay back.
No, I'm explaining. It's not mandatory you pay back. Yeah, you just include in your include. Now, if you are close to turning R, so you have to consider how much you have a RRSP, so you can start planning and trying to. For example, many of us after 65, they leave the job, maybe they go to lower bound, maybe they lay off, so they can start pulling from the RRSP. So I had a client, he is a pharmacist. He had his pharmacy shop a drug, he sold it out. He had a huge RRSP amount because he was in a higher bracket. After he was looking for buying his own pharmacy and he was not able to find it, so his income went very low. So I told him, like, start now pulling up, because on 40,000 you will be not paying taxes, because first 16,000 you get basic credit, you don't pay tax on first 16,000. Your spouse, if have no income, so almost 40,000 is free. So plan and take out as you can, but don't go above 40,000. So he start taking out. So because why you keep it then in future? Because it's better. So you have to plan, always be talk to your accountant for all this, because I had a client, his wife passed away and there was a huge RRSP, and half of the money of the RRSP went to the taxes because it's all lump sum payment. So I have to plan ahead of time. So that's the basic, we talk about the things. So FHSA is a really new, even my kids, he graduated, his friends is coming in and saying, oh, they open up the FHSA account. And my son told me, but I said, but he is jointly owner of his house with the parents. Why? So we have to even tell our kids about that, that they have to be, contact their accountant and think about it. So this is the basic thing. So as I earlier, we just shifted to FHSA and RRSP, but there is, like this year we had reduced that Canada Revenue Agency. So first bracket start for 15% taxes. From July, it become 14%. So they lowered down federal tax. Okay, but because it is started from the July, so basically 14.5 is the first bracket taxes. That was a very good change this year. And then people with the disabilities, if they are buying something, for example, they cannot hear or maybe read, so they have a voice recorder or voice saying books and stuff, so they can claim those expense against their tax. So this was another change, was this, it was a new credit, is a good credit for that. So these are the basic changes. Otherwise, like, it's very hard to make changes in income tax law. So it's very, every year just a one or two things is coming up. So, but these are the good one, but not too much. I don't like RSP because it's basically, at the end of the day, is lot of losing as well. So, but FHSA is a good thing. I always say, if you want to consider, you never bought the home, first put 40,000 in the FHSA, then move to RRSP. Don't jump directly to RRSP for new kids or whatever they are coming. So that will be. And the thing is that we have to, and one thing is brought up, my one client, he booked the condo and then there was a sale purchase agreement, and he was reading online and he got confused and he said, 3 years before I signed the agreement, and I read somewhere that October 31st of the, when I withdraw some fund, I have to, before next October 31st, I have to pay back. So he said, like, it's 3 years my house is not building and a developer is not giving me, and how it will work, because I have to report. So I explained them there is two things. If you already bought the house, you still have 30 days to put the money in FHSA and withdraw. And if you already withdraw within coming April, for example, if today you withdraw the fund from your FHSA, by next October 31st, you must have signed purchase agreement. So otherwise it will be included in your income. So that rule, so many people, they got confused. So if you already bought the home, you still have 30 days to open up the FHSA account and withdraw the fund. And if you already withdraw the fund, then you have coming October 31st to at least open the account, sign the sale purchase agreement. So there are really, because it's a new and so many people try to read online, they confused. So he said, oh, it's 3 years I signed the agreement and I'm not withdrawing the fund. Maybe I have to, I was reading and I have to withdraw by October 31st. I said, no, it's not that rule. It's opposite, that if you already withdraw, then you have next October 31st to at least sign the agreement. If you never signed the agreement till next October 31st and you already withdraw, you have to put it back. So that's the one. And if you had the limit of 40,000 and you put it in 48,000 in the FHSA account, so 8,000 excess amount give you 1% penalty every month. So that is also very like a thing about it. So you have to be really careful about that as well. So these are the basic things. And if you guys have any question or anything. TFSFA? So TSFA account, tax-free saving account, don't give you any tax deferral. It's nothing to do with like in the form of your tax. So for example, If you put it in 5,000 in RRSP, right away your taxable income will be reduced by 5,000. But tax-free saving account don't give you that deduction, but whatever the return you are making in that TSFA amount, that will be not taxable. So for example, if you invested you open up the tax-free saving account and you contributed 10,000 in Tesla stock, and every month you are making 1,000, that 1,000 will never be taxable as investment income in your end. That's a tax-free saving account. But you don't get any deduction out of tax-free saving account. FHSA account, you can get a deduction, but it's purely for the home buyer. RRSP serve both purpose for the home buyer or could keep it for your future saving. So that's a different plan stuff. Okay, so that's the few things I want to. But yeah. Yeah. So see, for example, for example, you have 6 kids, okay, and you have an income of 100,000. So still maybe you have to calculate like, okay, over 10, 15 years, the time value of money. But until your kids are under 18, you might, if your income, you put it in 25,000 RRSP, now your family income is 75 and you might get a higher child benefit because of that. Okay, so that, but again, you have to be careful until what time, how much maximum, and all those stuff. I got a client yesterday, even Saturday morning, I was even at home at that time. One client and called, said, bank calling me asking for RRSP loans. And they are asking, you can deduct this, that, what is this? So I told them, is nothing, is nothing. They are, because so many people, they don't have funds to buy the RRSP, they are giving, and they are giving you that, oh, interest you will pay and this loan will be tax deductible and this, but don't be like fool. It's just like a bank, they want your money. Okay, so that's why, yeah. So, yeah, so the home you live in, yeah, the investment, you have an investment property. Okay, you can. There is no tax implication for kids. Okay, here come inheritance gift is tax free. Okay, so you have 50,000 sitting in, and if you give it to your daughter, and she's getting married or whatever, so you bought her the home. Okay, she moved into that property. Okay, that house may be for 100,000 for say. Okay, so right now you give him 100,000, she bought the house, she moved in. After 3 years the house become 300,000, she sold it. Okay, no tax implication because that was a principal residence, she got a principal resident exemption. Yes, her name. Okay, but now what happened? If you have an investment property already on rented, okay, and your daughter got married, and you give as a this house to gift to her. For her, no tax application. For you, yes, because you deemed disposed of that house, and it was not a principal residence. So you bought at 100,000. The day you give to your daughter is 300,000. So now you had 200,000 capital gain, and half is this taxable. If your daughter, same week she sold it for 300,000. Okay, so no tax for her because it was the same price was her cost, because your cost was 100,000, fair market value of the house 300,000, you give her the gift. Okay, you pay tax on 200,000, but your daughter will be taxed. Same as inheritance. Okay, inheritance is your deceased return pay taxes on inheritance, but who is getting it, they don't pay taxes. Which money? No taxes. No. So you had 100,000 in the bank account, now they got it, is a gift, inheritance, no tax. You had a property renting out, then you pay tax, but they get it the tax free. So that's basically inheritance. No, fair market value, and you have to appoint appraisal or real estate agent who consider three properties. So for example, he said, I bought the house for 100,000 and I deemed disposition at 200,000. If he reported CRA didn't come back, he's fine. If the CRA comes, pick his file and start trying to see what was the fair market value, they sent him a letter saying that, can you send us the appraisal? Okay, so appraisal could be from the proper appraisal people and can be your real estate agent. They have to they have to maintain a report. Three properties in the similar one appraisal, but they have to give the reference of three properties. They says, okay, in this street, this house sold, almost same bedroom, almost same this. No, nearby house. But same thing, like, so they can say, according to my suggestion, this house is 200 or 300. Then they will ask, oh, you reported on this. Okay, but every time I ask, don't hide. Like nowadays in the tax return, you have to mention, even you sell your principal residence, you have to say. So many tax preparer, they don't mention it to you, but you have to tick this, that you did you sold any property where you are claiming, because in past everybody knew that principal resident no taxes, so there was no question in the tax return, and you don't have to declare that you sold any property which was your home. But what happened, so many people start misusing it, especially real estate agent and people who have the money. They buy the home, they move in, make a renovation, say this is our home, sell it for good money, move to the new house, sell this property, move. So now CRA make this question. You have to give the declaration that, oh, I sold the property where I'm claiming the principal resident exemption. If they see your taxes every year, you are saying, oh, I sold the property, oh, I sold the property. They says, how come you are selling your principal residence every year? Okay, so if they come and knock your door and say, oh, how come you are selling? So there could be a genuine reason. Maybe you bought the house in Mississauga and then you got a job same year in Ottawa and you have to move. And maybe next year you got a job back to Kitchener and you have to move. And maybe next year you have in the Montreal. So then you can say, here is the facts and that's why I moved. So you are fine. But if you cannot support why you sold the property, then they will say, no, this was not a principal residence. And even they also try to match what you are doing. Okay, so if you are a real estate agent and selling your principal residence every day, they say it's links to your what you do as well. So that means it is it's just a business. Okay, yes.
Regarding the RIF,
Yeah.
so suppose somebody has about 100,000 RIF available and retired person. So what should we do with that amount there? So should we try to withdraw like minimum amount like 5,000, 10,000 or more than that?
So that's why they are very clever. So that's why they made the RIF. That's why I don't like RRSP. They say it's like there is no saving. So for example, 71, if you take all your 300,000, you pay higher tax. If you convert into RIF, based on the inflation and everything, there is a certain installment you can take. If you go beyond, then they make you pay penalties and higher tax. Yeah, penalties and higher tax. So that's, and otherwise everybody can do it. So for example, if your income is low, you might start taking 40,000. So they are very like in this sense. Yeah, so that's the thing.
5,000 or 6,000?
Yeah, so that's why I see it's your own money, but it's a sweet candy sitting over there, but you cannot have it. Yeah, 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 and they take your funds and invest and take high return and give you just tax deferral. So
What will happen to that money if when you passed away, go to your kids
beneficiaries,
with taxes and such?
like final decease return pay all the taxes. For example, if I pass away and I had a 200,000, so that 200,000 will be jump into the income in the same. My decease return will pay taxes, my state will pay, and remaining will go to my kids. And even more than half,
More than half.
because it's 200,000.
So,
Yeah. No. So we are saying if you are open up a TSF account and you put 5,000, okay, in a tax-free saving account, okay. So, for example, you bought the stock of Tesla, okay, and they are giving you 500 dividend every year. So that 500 is not taxable, okay. But whatever the 5,000 you injected is not giving you any tax saving. If you injected 5,000 in RRSP, your income will be lower down by 5,000, you will pay lower taxes. Tax-free don't give you tax deferral. It's just give you the return you are making on tax-free saving account, that's not taxable. You can withdraw. Tax-free saving account, RRSP, when you inject, you save taxes. When you pull, you pay taxes. You can still withdraw, but you have to pay taxes. See, tax-free, like, it's depend on you, just like I was talking to before, and your situation, how old you are, if you had your first home already, and what's your plan, how high bracket you are in, then you have to plan how much RRSP is good. Personally, I don't like RRSP. Yeah, yeah, so that's the thing. It's just you are saving to pay taxes in for future. Thinking maybe at that time will be no taxes, but you never know. It even more taxes. And the money value is all gone, maybe at the time when you become 71. So it's really that you have to see. It's based on which bracket you are, how much tax, do you have a kid with lower family net income, are you getting higher child benefit, what's your plan for future, it's really depend on it. But still, I said, don't be too harsh, like be conservative. Don't put too much in RRSP.
I give example.
You are as a, yeah,
It was a 20,000 there, so I couldn't take also.
yeah,
And
yeah.
somebody told me that if you put this money with the insurance company, then you don't pay the penalty money to the next generation. Is it something like that?
That insurance is something we say is lifetime, this is for estate planning for corporate and retained earnings, not for personal. Yeah. So, for example,
If you make a trust, so then
no, trust, people think trust has, you can say trust is a separate person to pay taxes and very high tax rate. It's only benefited when you have a millions of dollar of estate. Otherwise, it's not is no question about this trust. Yeah, that will be not tax. Nothing. It will come to your in your hand. Even for example, if somebody passed away and they have 200,000 in the FHSA, it will be jump into their income, in not income, in their account, no tax, nothing. Yeah, according to the, it will be tax free goes to there, but there will be no tax for you. But if you have a RRSP, so for example, if you have a RSP 100,000 and you passed away, so RRSP income will be included in your tax. Your final decease return will pay taxes. That will be paid. Then that money will be available to distribute in your estate. Okay? But tax-free saving account, they just release to you because you never save any taxes. Now your final return don't have to pay tax anything. It's just a bank account. Yeah. 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 It's just a bank account. Yeah. It's just like that. Yeah. Yeah. So basically is this. Yeah. Okay, so I repeat FHSA. So you come here then. Because now you, or maybe here. Yeah. I already, no problem. No problem. So see, FHSA account is new. And it's, you need to understand, even for you or for your kids. Okay? So I get every day that a student, like graduating, they are starting and they are attempting to open up the FHSA account. Okay? But it's you have to be careful. If you have a kids, which you already had a home, and any of your kid is already in the mortgage or in the home title, okay, so and they are living in this house, so that means they cannot open up the FHSA account. So RRSP is retirement saving plan, can be used against the first home. But FHSA account is purely for the first home. So you must be 18 above, you are the Canadian resident, and last 4 years you never had a home jointly with spouse or parents. Last, before 4 years, no. Yeah, so for example, you had a home, you sold it, and last 4 5 years you are living on rent and you never bought a, then you, yes, you can open up the FHA. Yeah, FHSA account. So do you work? You have employment income? Yeah, so then, so what's the benefit is that it's the lifetime room is 40,000. So for example, it's in existence from the last 2 years. For example, in 2023 or 2024, you went and opened a FHSA account, but you never contributed anything in it. It's open, but you never put in any money. So 2024, 2025, all room is available in 27. Yeah, so yeah, so 8,000 for 23, 8,000 for 24, 8,000 for 25. So all of the sudden you can put all money together in next year. So 32,000. Okay? But if you never opened the account and today you want to open, you have only 8,000. So it's a good thing if you are considering first home, you and just open up the account. Even if you don't have funds, just open up the account. Even you bought the house in 15 years, after within 30 days of buying the home, you can open, you can put the 40,000, take it back, and save the taxes. So it's the best thing. Like RRSP is not like that. You have to, it's pre-RRSP. But for FHSA, if you already open the account, after 5 years, you have 40,000 room available. Keep it, keep it, keep it, because you are not certain whether you will buy the home or no. Maybe after 10 years, you bought the home, and you remember, oh, I had FHSA, it's open. You went, put the 40,000 in, removed it again, and you claim as a deduction against them.
My son who is 18 or 19,
He can also open
but in his name.
in his name. Everybody is his own name. So you and your husband can open, and you can both jointly use against one home. And your son, he can use his for his home. Yeah.
And does it operate like a TFS that you can invest in other things,
Yes, FHSA, yes.
Same like you can invest.
Yeah, you can invest. The only thing is that you can only withdraw against the home. No other way.
I got it. Yeah.
Otherwise, you have to convert into RIF or RRSP, but no other way.
And in the FHSA, if you
So for example, you went to, like, so many people, they don't like losing money. They said mutual funds.
But even mutual funds,
You don't get anything.
no, but which one? You see, nothing is really Sharia
That,
compliant.
no, there is a lot of Sharia compliance, Iman fund, there is lots. But you have to go to those who deal with Sharia compliance. And plus, see, there is a,
So you can open an FHSA with them.
yeah, so the thing is that you cannot go for the interest base, but you can buy the shares and get the dividend,
Yeah, I think which shares, that's the problem.
but not the banks and stuff.
No.
Yeah,
I know that. Like,
but now all other shares are, yeah.
when I was looking at the ETF, SPUS and HLAL and the Wahid share, but they also all invest in Coke and Johnson and Johnson and Unilever
Yeah,
and Pepsi.
that's the boycott thing.
These are boycott.
Yeah, that's, but other than this, usually people look dividend versus interest. So interest is, yeah. But now we have more because of the Palestine. We are just doing this.
Because I invest in SPUS and also HLAL and that Wahid WHSR,
Yeah,
on
yeah,
the stock exchange. But when you look at the breakup, it's all PepsiCo, Coke,
yeah. So yes,
Johnson and Johnson.
yeah. This nowadays so hard. So that's why I'm
Something
saying
purely halal,
that will be really hard.
except one, gold.
Yes, gold.
Gold is
Gold, yes,
to invest in.
yes, because it's now going down, but it is indication that in future it will be,
Today,
yeah, yeah, it will be. Last week it will go down, but it will.
it was very bad, but today,
And the long-term prediction, it will go higher and higher.
today it went up.
Yeah,
Recovered from
yeah,
its downfall.
yeah,
It went up a little bit.
yeah,
Silver is still down.
yeah.
My friend is on this board which gives this halal certification.
Of,
Yeah, with Sheikh Slimi and all.
yeah, yeah, yeah.
So she's on that board. So she told me, she said, if you want to invest in this. And gold also, not the
It's
physical,
physical.
gold, but the shape.
Yeah, yeah, you can just, they are keeping it. Yeah, yeah, yeah. So, yeah, so if you can, your kids, but for example, if you open up FHS account, your son open up FHS account, you both together wanna buy a home, not house, not investment property, consider that. Yes, the house, if you withdraw against FHSA, within 1 year you have to move in that house. Yeah, you cannot put it on rent.
Obviously, you're
Yeah.
doing that to save for a home, right?
Yes, yes, it's
Because I want my children to start saving for a home.
if they are working, high income, at least the deduction only help them when there's a high income. So at least they open up. Within 15 years they have.
Accumulates.
Yeah, yeah, ठीक है.
मेरी होगी, I got all the information.
नहीं नहीं कोई
Thank
बात
you so
नहीं,
much.
no problem.
You can visit her.
Yeah, yeah.
I asked a lot of questions,
Oh yeah, she's good at it.
but you've answered a lot of them.